Today we're going to start our first segment on order types. Now, order types are pretty simple and there are not a lot of them, but they have these small differences in order execution that make them really important to our trading. So we're going to learn how we use them, when we use them, and why we use them. Now, today we're just going to go over the market order because it's the most simple, so it makes sense that that's the first video. But we will go over all of them, of course. And if you like the video, please subscribe to our channel. And if there's any videos that you want me to make on any other topics, financial related, I would love to do that for you. Just leave that in the comments. Let's get after it. So market orders. Why are market orders important? Well, one, a market order could be the difference between a profit or a loss. And sometimes a market order is the right order for the job. Generally, we do not try to take losses unless it's for tax purposes, so we're normally aiming for profits. Two, we need to understand market orders because they can be disastrous for our account if we use them in the wrong situation, meaning we could lose a lot of money. Market orders are able to be used during the standard market session, which is Monday through Friday on business days. So there are market holidays like Christmas. We cannot trade with market orders on those days. And that's from 9:30 a.m. to 4 p.m. Eastern Time. Let's say you place an order at 4:01 p.m. Eastern Time, let's say on a Friday. Then that order will execute at market open the next business day, which would be 9:30 a.m. Monday morning, assuming Monday's not a holiday. Now, let's assume that you have enough buyers and sellers in a security, meaning that it's a liquid security. A market order will execute immediately, and it will execute at the next available price. These market mechanics on this order can have pros and cons. So the pro is that it's guaranteed execution immediately. So if you're trying to just get in or out of a security, then you can do that quickly. Like let's say a security is going up in value really quickly, you just want to hop on the train, or if it's going down and you want to hop off the train, you don't really care as much about small price fluctuations. The cons is you don't know what the price will be. It's normally around the bid or the ask, but it could be different depending on the amount of shares. For example, let's just go over this. When we're buying using a market order, the price should be around the ask that you see. And if we're selling, the price should be around the bid that you see. But of course, this depends on how many shares are available at that bid or ask. If there's only, let's say, 10,000 shares available at the bid, and you place an order for 15,000, only the 10,000 will fill at the bid, and the other 5,000 will be the next available price. So, and if you don't know what I'm talking about, please go watch our stock quotes video to understand the bid and the ask. And then another thing to know is when you place the order, the market could fluctuate between the time you actually place the order and from when you saw the price. A time at which we do not want to place market orders is when we're trading options that have a big spread between the bid and the ask. And I have an example here. We have the security GameStop, which has become popular recently. That's symbol GME. And we'll be looking at the calls, which is a type of options contract. If you don't know what that means, it's okay. I'll make videos in the future explaining what calls are. And this specific one has an expiration date of September 17th, 2021, a strike price of $155. And it's a call, of course. And we have a bid of $22.05 and an ask of $23.60. And this is a big spread between the bid and the ask, and I'll show you why here. And if we place a market order, for example, to buy this option contract, that will go through at the ask price, the $23.60. Now, just to see how much more you're paying above the bid, which is the next person or the highest person willing to buy, that's $23.60, which is the ask, minus the bid, $22.05. That's a difference of $1.55. And if we multiply that by 100, because an options contract represents 100 shares of the underlying security, we'll see that that is a total cost of $155. So you'd be paying $155 more than the person with the next highest bid. And so we do not want to pay that much more than the bid on this contract. So we would probably want to place a limit order in order to avoid doing that. So when we're trading options, we normally want to place limit orders. Now, another scenario is with a penny stock, a thinly traded security. We have Advantis Corp, symbol ADVT, and that's a penny stock we know certainly from the price, last traded at $0.0004. And we can also see here that that's pink. That means pink sheets. So that means it's traded over the counter. Now, I found this on the Caveat Emptor sheet from TD Ameritrade, and the Caveat Emptor sheet means buyer beware. So that's TD Ameritrade telling people stay away from these securities because you could lose money on them. And sometimes they might not even let you buy them. And let's say you saw the security and you were like, oh, wow, it traded at 0.0004. That's good. I want to buy it. Well, if you place a market order to buy, you'd get the ask of 0.01, which is well above that market price you saw of 0.0004. And if we do some division here, we will see that that's actually 25 times the value that you thought you were getting the security for, which is way higher. Way, way higher. So we want to avoid the market order on this security. Now, if we just do it in a larger volume, because normally people buy these in larger quantities because they're really cheap. Like let's say if we did 10,000 shares at 0.004, which is what you thought you were going to get the security for, you would spend a total of $4. But in reality, if you place a market order, you get it at the ask of 0.01 and spend a total of $100. So that's $96 more than you expected to pay. So that's basically an unrealized loss immediately of $96 without even having the chance of a market fluctuation or profit, just because you placed a market order on this security. And so again, this is something we want to avoid. Now, if we look at the size of the ask, which is 10,000 shares, so 10,000 shares available at the ask, if you place an order that is larger than a quantity of 10,000 shares, then you do not know what price you're going to get on the shares greater than 10,000. So for example, if you do 11,000 shares, then the 1,000 shares above 10,000 might have a random price way higher than 0.01. And so if we look down at the market depth, which is underneath, and you have to kind of pay for this. I was a stockbroker, I don't have to. There's no orders above or below the inside bid and ask there. So the next available price could be $50 after those 10,000 shares. So for example, if we go back to our example where you place an order for 11,000 shares, those 1,000 shares could be at $50 per share. So you end up spending $5,000 instead of the 0.0004 per share. And this has happened in clients' accounts. I've seen it blow up their account and lose thousands of dollars on a trade like this. Now I'm going to place a market order for you guys. I found FedEx here, symbol FDX, last traded at $276.03. That's up 91 cents for today. And I didn't really want to place a buy because I think there's going to be a correction in the market. But I did notice that FedEx had this interesting chart formation here. And I'm going to go through this with you. Of course, you don't know what these things mean yet. I will make videos teaching you, but for right now, just kind of follow along. We see here that it gaps down, meaning that the price opened way lower than the closing price the previous day. And we also see it's trading below the 200 simple moving average, 200-day simple moving average, which could be kind of bearish sentiment there. And then the other thing I see is a doji candlestick, which normally can go either way, bearish or bullish. And so the technical indicators kind of show me that it might go down really in the short term, but I am long FedEx. I think they're fundamentally a good company and that they are going to go up in the future. Maybe not in the short term, but in the future they will. So I'm going to look at this as a discount for me to purchase it. And so now I'm going to look at this gap to find what the date was. I see it was July 27th when it gapped down. So there's probably some market news out for that day, that reason why it went down. So I'm going to change the date here to the 26th to kind of zone in on that day. and look up some articles for the market news. And so I see a couple interesting ones. I see the UPS shares hit 3-month low on worries of e-commerce is cooling. Shares worst day in 9 months. So I'm going to read that, and I see that there might be some data out there talking about how e-commerce is probably going to relax a little bit, and that's not fundamentally good for these delivery companies, because the more people buy online, the more deliveries they have, the more profit they make. But I think long term that it will be okay. So I'm going to place an order for you guys. And so it's 3:49 p.m., 11 minutes till market close. The stock's not very volatile right now. It's not really moving that much. And I don't really care about little differences in pennies. So I'm going to place a market order to buy. So that's changing it to 1 share, reinvest dividends. Smart, that just means standard market session. And Schwab's going to route the order to the best place to execute. The order type, we're going to do market. You see there's other ones here. I will explain those later. We're going to do a day order, meaning it expires at the end of the trading day if it doesn't fill. If it all looks good, we'll review it. We'll check it one more time. And it looks good again. Dividends will be reinvested. Place order. Now look in the bottom right hand of the screen. You'll see that my order executed. And I now have 1 share of FedEx in my account. Now, this is how quick a market order takes place. It's immediately at the next available price. So that's why it happened so quickly there. And it was a price really close to the ask in the last traded price. Now, so just to recap, market orders are quick. We use them to get in and or out of position, not really caring about small fluctuations in price. Thank you so much for listening to my video today. I love teaching you about market orders. Come back for more. I will teach you a lot more things, and also leave comments if you want me to teach you something else. Thank you.